afternoon, folks. It's Dave Burrows. I'm Chief Investment Strategist and President here at Barometer Capital Management. And I want to welcome you to our regular Tuesday afternoon Barometer Readings webcast. So much to talk about today. There's a ton of issues that markets are dealing with. And at the end of the day, we got to remember that the market is a giant machine. There's 1,000 moving parts. Trying to figure out what the output should be given all of the machinations that are taking place is about trying to unwind a plate of spaghetti. So what we have to do is have tools to understand what is happening and try and understand why that may be and make sure that portfolios are set up to deal with whatever the current situation is. So what we're going to do over the next sort of 40 minutes is just quickly run through top down what we see going on in the world, what's changed over the course of the week, where money is flowing to, where money is leaving. And we'll talk a little bit about how we're structuring portfolios to try to deal with what has been, a very, very tricky year for investors in general. The one thing I know is true, though, is that if we made decisions based on how we feel, the portfolios would look very different year to date. But you have to have process. You have to have discipline. You got to have rules. And we try and articulate some of those as we go through these webcasts that we do weekly. So thanks very much for joining us. Just to start really from the very top down, from an asset class perspective, remember 80% of return is getting to the right neighborhood, being in the asset classes that have a tailwind. And then within those asset classes, identifying structural themes that can be revalued over a period of time and are showing signs of doing so, both positively and negatively. And then we have to populate portfolios with securities that meet tests that help us to find situations that are good getting better, where we can express a view in the themes that have a tailwind with companies or securities that are improving over time, aren't broken getting fixed, but are good getting better. So from a market perspective, we have had a view that we entered a secular bull market in 2013 in equities, led by U.S. equities. And we have been in that bull market since. We've certainly had pullbacks along the way, and it is up for debate as to whether, in fact, we continue to be in a structural bull market. We believe that we are, but that can change, and we have to remain open to the alternatives. When we put the S&P 500 under a lens with the 1980s and 90s bull market, followed by the structural bear market that started in 2000, didn't end until 2013. And then the bull market we've been in since then. This is up to this afternoon. S&P, these are weekly bars. The S&P so far up on the week about 5%. We've been highlighting the fact that in a structural bull market, stocks tend to stay above a rising 200-week moving average. And certainly we have pullbacks along the way, as we did in the 80s and 90s. And as we have had since 2013, and not to say they aren't unnerving and not to say that they aren't uncomfortable, but they happen. And the reason that we stay interested is because we know what comes after them are very significant and consistent run-ups in price. So I remain open to the fact that at some point we could break that 200-week moving average. And as it did in 2001, it could roll over and meander its way sideways for several years. At this point, it remains firmly in an uptrend. We remain above the 200-week moving average. And there's certainly good spots and bad spots in the market to worry about. But the backdrop at the equity level is that we remain in a structural bull market. Now, last week, we talked about the fact in early October, we had a 293-1 up volume versus down volume day. They are very rare. They tend to happen at important inflection points for markets. And we will see if this one is one of them. But since then, we have had a number of 2% up and down days, not comfortable. But we have had 2 over 90% up volume days since then. So what do we need to see? We need to see continuation. Here's the S&P 500. This is the corrective period we've been in since the beginning of 2022. At the worst point, S&P down 27.18%. We had a very strong day 4 days ago. We gave almost half of it back the following day. That was Friday. Lots of concern as to what we might see come in on Monday. Very strong up day, 93% up volume on Monday. And Tuesday, we wind up actually a little higher than where this chart's showing, because this is from sometime this afternoon. But we went out very close to the top third of the trading for the day. Now, we said last week, what was interesting is that despite the fact we went back at the index level and retested the lows from June, the breadth models that we follow started to turn higher. That doesn't mean everything started to turn higher. Obviously, the index went lower. But some pockets of the market actually set in substantially higher lows in October than they did in June. These are the things we're watching for as markets go through a process of trying to find a bottom. Now, it might be a near-term bottom, and it could break later. It could be something more substantial, but we have to start somewhere. So it's an important thing to look at. When we look at the TSX relative to the S&P, it's actually quite a different story. TSX didn't start its bull market until later. In fact, it tends to act quite differently than the S&P 500 and certainly the NASDAQ. The sectoral makeup is very, very different. And so the TSX actually has been more constructive than almost any market over the course of the year so far. So clues that we look at for signs that we're working our way through a process, right? We've been tracking volatility. We know that when markets are particularly jittery or expecting big outsized moves, volatility tends to spike. And I put on the chart the March of 2020 low in the market when volatility, or VIX, spiked to over 80. That meant at this point, people were looking for sort of 3-4% daily moves. And while we did have a big spike in VIX at the beginning of the sell-off, we put in lower highs in volatility since. Now, it's not to say, again, that we can't get a higher high, but having said that, despite real concerns of a market break below that 200-week moving average, volatility has been unable to make a new high. And in fact, today closes below the low from last week and below the low from the week before and below the opening from the week before. So we're really at a 4-week low on a closing basis in VIX. So this is not pointing to substantial more volatility at this point. Now, let's move on to bonds. The bond market, similar to equities, has big long-term structural shifts. We've had periods where we had long run-ups in yields and long moves down in yields. The last run-up in yields significant started in the late 1940s, and it went on to 1981. And it's not to say it was a straight line. There were lots of squiggles along the way, corrections. But in general, you were in a reflating economy. The Fed had held interest rates artificially low to help countries deal with the debt that was built up during the war. You could argue that that's what's been happening in developed economies around the world over the last few years. But yields certainly are moving higher. We are no longer in falling interest rates, which we have been for the most part in most of our investing lives since 1981. And it means that the environment is different. Different things are likely to work. Things that worked in falling rates are not likely to work necessarily in rising rates. So bonds are obviously one of them. This is the TLT ETF, which is the 20-plus year U.S. Treasury bond ETF. With one trade, you can own the long end of the U.S. bond market. And for a long time, while the yields were not exceptional, you were getting capital growth along the way as bond prices moved higher, but certainly not the case since 2020. In fact, the TLT has now had a structural 45% decline in price. Very difficult for a bond investor to accept a 45% decline in price. Now, you've had some coupons along the way, but we're talking about 1 to 2%. And at one point last year, down as low as about 1% on the 30-year. This is the 10-year bond yield since 1981. Clearly, we saw a structural redirection or the beginning of a rates bull market or a bond bear market, clearly, that took place 2021 and 22. So this has been a place to avoid. So from an asset class perspective, Equities in general over the last number of years have been a pretty good place to be, although difficult this year. Bonds have been a pretty good place to be, but very difficult this year. No tailwind there right now. And we know that when we put it into the scheme of things, that US government bonds as an aggregate have had the fourth worst year going back to 1701. The last year nearly as bad was in 1920. When we look at the 10-year bond back to 1900, there have been no years like this year. This is something we have to keep an eye on. Not because we're concerned about the US government's ability to fund, but this is happening everywhere in the world. And there are weaker bond markets that are having more trouble. And we've heard about difficulties in the British gilt, the British sovereign bond. We've heard about potential difficulties in the Japanese bond market. And so bonds have been an asset class for us to avoid this year, thankfully, because when you put a difficult stock market together with a difficult bond market year, this has been the worst year on record. With the 10-year bond down substantially, the equity market down substantially, these numbers are about a week out of date, makes for a very difficult return for a 60-40 equities bond portfolio. The only year that matches it is 1931, but obviously equities were way worse and bonds a lot better. But this is an unusual outlier, and it's not to be used to determine what might happen going forward, other than generally, it would be very unusual to have this happen twice. So let's look at commodities, another important asset class, not one very well liked, certainly because it underperformed from 2008 to 2021. And as you can imagine, if you were a producer of commodities, you were not incented to go out and invest more in capacity or new production. The thing we know about commodities is when they are underinvested in over a period of years, at some point there winds up being a structural shortage, and it's very difficult to put commodities in general into production in a hurry. So even though we are seeing a very substantial tightening in the Fed cycle, commodities have come off, but it's actually been quite muted. We know that when commodities start to outperform stocks, this is a chart that charts the S&P, Goldman Sachs Commodities Index, Total Return Index versus the S&P 500. Over time, there are long cycles higher in commodity prices versus stocks, and then long cycles lower. And we've been through a very substantial bear market in commodities. They recently have started to relatively outperform. And when that starts, it tends to go on for a long time because you have to invest in capacity to bring on new supply. This is where we are in the CapEx or capital spending cycle. This is not the time to buy commodities. This is not the time to buy commodities in general. This is when you want to own a commodities producer or the commodity itself, because generally it means you're fairly well protected from new supply coming on the market and roiling prices. Let's look at the underlying pieces. Well, certainly oil or energy is one of the most important. This is Brent US oil. We can see the bear market that it was in from 2014 through 2022. We exited that bear market in the beginning of 2022 as we made new highs. We certainly have consolidated down to the moving averages, but the BNO ETF, which is an ETF that houses a proxy on oil prices, is trading better than 90% of all the companies in the S&P 500 so far in the year, since 2020, and certainly acting well this year. And again, very poor capital spending in the area. When we look at the point and figure chart, which we tend to like to use, it helps us to recognize inflection points. After correcting from the high of $124, we reversed that over the last couple of weeks. We've pulled back a little off that high, but we remain on a buy signal. And for the XLE, which is the index of energy producers, same thing, positive point and figure chart. And in fact, our breadth models for the energy producers and the service companies is positive and expanding, meaning more and more stocks are participating in this rally. All of that, despite the fact that the U.S. has been selling off the strategic reserve. So we talked last week about the fact that we're down to 22 days of supply. In fact, within the strategic reserve, some of the reserves previously have been pledged as collateral for other ventures, so they're not accessible. Some of them, there is some question as to whether they even can come out of the ground because you need pressure to bring them out of the ground. But it looks as though the US government is set to sell another 14 million barrels, which would exhaust the 180 million barrels, which they pledged to put into the market in the spring of this year. So surprising that energy has been as strong as it has, and that perhaps helps explain why, while oil has come off some over the last couple of weeks, energy producers have remained very firm, probably looking beyond the end of this introduction of strategic reserves into the market. Funny how that could happen just before an election. Let's look beyond energy. Base metals certainly have pulled back. They came out of a structural bear market. They pulled back to a long-term rising moving average. That's a 200-week moving average. And we know inventories here are very low as well. But again, some of the producers behaving much better than the commodity itself, something that I really care about. I always am more interested as to what the producers are doing than the commodity themselves, because people are making a bet on the future earnings, not the current price. And so Teck Resources, as a great example of a diversified resources company, came out of the bear market. Commodities certainly pulled back, but actually when the market bottomed in June, fine, it was at a low. Market made a new low in October. Look at where Teck Resources traded in October. And here we are breaking out of this range that we've been in to the upside. One of the most important things you can do as you're going through a process of maybe even near-term market bottoming is see what is it that's holding up better than the market, right? The market is a great sorting hat. When people are concerned about the market, concerned about the economy, they look at their holdings and say, what should I sell? What do I have least amount of conviction in? When they put money to work at a really difficult time, they don't run out to buy the things they think are most broken. They buy the things they have most confidence in. So I really care to see what is it that bottomed with the market, but then puts in a substantially higher low when the market retests the low, and what's able to move forward. This has been trading higher over the last 4 weeks while the market has been very weak. Gold also found some support. So commodities, we believe, have started a structural bull market, and they will have pullbacks for sure. And they are not immune to Fed hikes, although you can't get more production out of Fed hikes. And you're beholden to weak economic conditions. But really everywhere within the commodity and basic material space, we've seen a shift, not only metals and energy, but agricultural commodities as well. So I'm going to just talk for a second about the dollar here, because this is an important juncture. Despite the fact that the dollar has been moving smartly higher versus the yen, the pound, and the euro, those basic materials have held in quite well. Now, generally, because they're priced in US dollars, when the US dollar goes higher, commodity prices are generally very weak. So we've had quite an outsized move. In fact, we're very extended above the long-term moving average in the US dollar. And it's not to say that there isn't good reason for the US dollar to be strong. They have been raising rates quite sharply. But now the rest of the world is starting to raise rates as well. And very often when you get extended a long way away from the moving averages, it will pull back. So what might happen to those basic materials and commodities if the US dollar were to start to pull back? We certainly do normally see pullbacks, even if this is an established bull run in the US dollar. Well, I put this up last week because this generally happens around turning points. Front cover of a magazine, we'll see whether the front cover indicator winds up being right and winds up calling a near-term high in the US dollar. We do know, though, that hedgers have put on their hedge positions, and generally by the time this is rolling over is when we start to see some short-term weakness. Okay, real estate. Real estate had a bit of a bounce this week. This is the RWR, which is an ETF that houses a whole bunch of REIT holdings. But down 35% on the year at the low point 2 weeks ago. and certainly not enough to make a change here. Real estate generally hurt by rising rates. And we know that we've seen 2 solid back-to-back months of falling house prices in the US. We certainly have seen very low activity as there's a mismatch between a seller's expectations for price and buyers willing to pay a price. And we are exceptionally acutely aware of real estate prices, given that we live here in Toronto. And as per UBS Global Real Estate Bubble Index, Toronto is probably the most expensive city in the world. So look, we all are trying to balance our holdings. We're all trying to balance our portfolios. We want to own things that are relevant today, not just a mishmash of everything, hoping that something will work. At Barometer, we have this view that our job is to identify market leadership themes, things that can be revalued, that are currently being revalued, where there's evidence and a reason why, and focus in those areas. We're always looking for new leadership to emerge. And in the absence of leadership, we believe, and not everybody believes this, that we can be out of big parts of the market and on the sidelines, or out of an asset class, like we have been out of bonds for a long time, and just be very targeted and tactical. Right? We think that the most important job that we have is to make sure that we don't go through a prolonged decline where people become so uncomfortable they can't handle a further drawdown, even when they know likely down the road they'll be brought back on side by time. So our job is to be focused in areas of strength, avoid areas of weakness, be willing to make changes in the portfolio. We're being paid a management fee to actively manage a portfolio and have a process for doing that. And that's why we do these webcasts. We start with a top-down view of the world because these 2 pieces make up a big part of where return comes from. We try to take all of the investable universes that we could focus in and drill down to a few that are seeing positive or constructive behavior where money is getting put to work currently, and focus in those areas. We run process every day to say, is there anything changing in the output? New groups emerging, old groups receding. And then we try to identify securities that we can use to express our view in those themes. In our bottom-up security selection work, where our research team tries to identify securities with financial characteristics that are good, getting better, improving, and from a strong base, and where the price behavior of those securities shows that it's outperforming its peers and is resilient in the market. And then the third piece of the process is a very disciplined selling process. And I had the opportunity to comment for an article for the Globe and Mail this week. And they had 2 advisors who talked about the fact that you really should never sell. You should be prepared to hold through any drawdown. And that's fine. I don't think that lots of people want to do that all the time. We think it's important to make sure a little mistake doesn't turn into a big one. And so we use stop losses in all of our positions. As they work out, as we hope or expect, we ratchet stop losses up and behind. And the difference between current price and our stop loss is our risk budget, the amount that we're willing to give up before we admit we're wrong. The top-down model is all about trying to find parts of the market that are seeing expansion and breadth. In other words, where more and more securities are participating in a rally. That's a healthy market. That's an expanding market. There's no bear market in history ever took place while breadth was expanding. And that's important because we're going to talk about breadth next. When breadth starts to contract, meaning the leaders carry on, but the weaklings start to fall away, that tells us there isn't enough new money coming in. There's enough money leaving where the risk reward levels have changed. That's a red light for us. We got to tighten up our stops. We got to raise some cash. We stop putting any new money in that universe. Now, it could be a whole market. It could be specific industry groups. But the idea is we only want to own areas that are showing expanding breadth. It doesn't mean we're going to sell everything when breadth rolls over, but it does mean we're going to use stop losses to moderate how much risk we take. So let's talk about leadership. Last week, we talked about the fact that the percent of stocks in the US stock market that were in clearly defined uptrends had started to expand, which is interesting because it was happening as the market was making a new low. So that doesn't mean everything was moving higher, but there were certain securities or industries within the market that for whatever reason were starting to buck the trend. That's interesting to us. That's new money getting put to work, especially when things are difficult. you have to sit up and take notice of that. Well, the percent of stocks in uptrends in the NYSE continued to expand this week. We moved from a low point of about 16% of stocks in the US in uptrends. Today, it's about 28% and expanded some more today. Canada is yet to see a reversal up, but still is sitting around 25%. So 25% of stocks in the market are behaving constructively, the rest poorly. And globally, it's about the same. But under the surface, the percent of stocks trading above their 50-day moving average or 10-week moving average also expanded this week to closer to 30%. Importantly, a third point turned positive this week. The percent of stocks with positive weekly price momentum, meaning upward trajectory in price. And that moved sharply higher from about 10% to about 40%. These are all things that we like to see that tell us something's changing. Now, that might be for a shorter term period. It might be for something longer. But to put it on the screen, I'll explain why we think it's important. This is a percentage reading on the right-hand side or the left-hand side. That's the x-axis. This is time along the bottom. On this chart, we have from 2007 through the present. And you can see that when the market bottomed in 2008 and 9, there was a series of lows in this reading. First in the fall of 2008, again around Christmas, and again around March. That was a process where the market was bottoming. And during that period, certain securities outperformed others and showed where the leadership might come from when we finally got the low and breadth started to really expand. We had a similar low in 2011 in October. We had a low in 2016 after the 2015-16 sell-off in stocks. We had a correction that ended in December of 2018, which I acutely am aware of because it was December 26th, and there was almost an 8% reversal on the day that it turned. It was the turn in March of 2020 when it felt like the wheels were completely coming off the bus with COVID. And we've seen two lows this summer, a low in June and another low in October. And we reversed at the beginning of October. So we'll see. But these tend to be important inflection points. And it may be we'll have more testing to do at some point over the winter, but at this point, it gives us reason to put on some small positions. Percent of stocks trading above the 50-day moving average also got exceedingly low. We got down to 4%. Last time we were there again was in March of 2020. And when it reversed and started to move higher, that was a sign that the pressure was coming off. Certainly there were reasons to be worried. It's what got you there. Well, today, this will have moved up another 5 or 6%. So we're probably closer to 30 as of today from a low of 4. I think that's important. And when we talked about the percent of stocks with positive momentum, same thing, the lows in March of 2020, the lows that we've been going through over the course of this past few weeks. And again, this will have moved higher again today. So we're not about predicting, we're about recognizing change, calculating what's actually happening to understand whether people are putting money to work or not. And in every case, in and around market lows, there will be 50 reasons why you'd be crazy to want to put money to work in stocks, because generally you want to sell everything. But there is some positive change taking place. For the NASDAQ 100, we have not seen that at this point. So again, it's targeted. Let's talk sectors. This is all the major sectors in the US market. We put them on a distribution curve based on what percent of stocks are behaving constructively. And the ones in capital letters are showing expansion in breadth. In other words, constructive behavior. Let's look at the groups. Precious metals, chemicals, autos, apparel, insurance, aerospace, forest products, leisure, steel, gaming, oil service and oil, transportation, restaurants. These are all pretty economically sensitive groups. You could bulk them together, resources and commodities, industrials, that's transportation and aerospace and machinery, and chemicals and basic materials, and financials, all groups that are fairly economically sensitive. Interesting that they've turned positive. Let's look at the underlying groups. Here's the TSX S&P Capped Energy Index. The light blue line is the line that shows performance relative to the S&P 500. And you can see that it has been rising steadily for months, and we're not that far from highs, certainly up on the year. The XOP ETF is the ETF that holds big US energy producers. Same thing, relative strength has been rising. Actually, this ETF's up 41% on the year, nowhere near lows, and certainly a long way from the low that it hit in June. That's positive divergence away from the market. That is money getting put to work. It's not short covering because this has been a strong group. Every time the XLE ETF, which is the broad energy sector ETF, has come down to the trend line, it's bounced off nicely, very, very constructive. Energy price performance of energy producers versus the S&P has been rising nicely. And when that begins, like it did in 1999, it tends to go on for a long time. So we not only want to buy something because we think there's good fundamental reason, there's a shortage of supply and not enough new production coming on, but we also want to see prices act the way they should, given what we think we know. And that's exactly what's happening. CapEx will come, or production will come, but it takes time because senior executives have learned that the market wants to see capital return by way of dividends or share buybacks more than they want to see growth in production. Energy infrastructure similarly is behaving very well. Again, a long way from the lows in June, trading better than 90% of companies in the S&P 500, another energy component performing well. Let's move on to financials. This is the ETF that houses regional banks in the US, a broad list of them, 1 to 2% holdings. Relative strength has been rising since March, way before the market bottomed. And certainly trading better than 74% of companies in the S&P, not near the lows. We've seen rising relative strength here. We've seen a positive point and figure chart for the banks ETF. Nice run up through 2020 and 21. We certainly pulled back, rallied, made a higher low, and now here we are breaking the most recent high and into a new uptrend. We'll see whether this persists, but this is not very recessionary. When Bank of America came out this week on their earnings, they said that their deposits were up sharply over a year ago and that consumers were spending comfortably. And at this point, they don't see signs of stress. Their net interest margin that they're making on deposits on the accounts have gone up because long-term rates are moving much higher. And that was the message across the banks, whether it was JP Morgan or Bank of America. Banks so far reported really good numbers, including Goldman Sachs today. When we look at the long-term picture for the KBE Financials ETF, Banks ETF, a long period of underperformance from 2008 through 2020, broke out, pulled back to the long-term moving average. This is very constructive. So this can change, but at this point, we have to give the benefit of the doubt. We're actually trading close to a 4-month high. Insurance ETF also sharply improving relative strength. That's what we would like to see. And in some of our underlying holdings, we're getting great result. Element Fleet Management is a Canadian company that provides financing for fleets of commercial vehicles. They provide services as well. They have nicely growing earnings. And look at this, at the first sign of strength for the overall market, it popped up to a new high. It's exactly what we want to see. Every bear market will lead to a new list of leading companies, and you can find them before people are really looking by following to see what is it that is able to buck the trend in a weak market. In the XME metals and mining ETF in the basic materials area, still rising relative strength, improving point and figure price chart. And then if we were to move forward and take a look at what's happening in some of the underlying companies, Sigma Lithium is a company that we added as bullish percent turned higher for equities, as our breadth model turned higher for the metals group. Again, very quickly has gone on to make new highs. Sigma Lithium is a lithium mining company has all kinds of mineral rights. And look at the estimate expected to go from losing 27 cents in 2022 to earning $4.57 in 2023. No wonder the stock's performing well. I think I jumped over tech resources, which I had here somewhere. No, I must have missed it. Healthcare relative strength continues to improve. Biotech relative strength continues to improve. In fact, way above the lows from May and June. Industrials, nice rising relative strength. Within that, aerospace, which is a group we've talked about for some time. Obviously, the defense sector has a tailwind. Lockheed Martin today reported numbers well ahead of estimates, was up 10.5% on the day. Northrop Grumman was up 5.6%, and General Dynamics up 3.5%. What holds up through a difficult market often will outperform when things get even a little bit better. And that's why we have to be willing to stay with positions that stay within their long-term uptrends, while we don't go to 0% equities, because you can't put these positions on quickly enough when things start to turn. Also within the industrials, some of the transport stocks behave quite well. Transforce has just been on a tear, and for good reason. They bought the ground-based operations of UPS and are integrating them, and the expectations are earnings will move nicely higher. So there are some haves, and the have-nots don't seem to be changing. Despite a nice bounce in the NASDAQ over the last couple of days, the IYW iShares Technology ETF made a new relative strength low today. So percentage point move higher, great. We're trading at much lower lows than where we were in June, not so good. Long-term and short-term moving averages are all heading lower. I understand that technology is a favorite of a lot of investors. This group continues to be for sale, I think, because it continues to be overowned. The NASDAQ 100, similarly, up today. When I took this picture a half hour before the market closed, it was on the lows for the day. I think closed a little bit better than this, but relative strength, new low, substantial lower low than June. Every time these things rally, it appears that people come out of the woodwork wanting to just lighten up their positions. Communications continues to be difficult, although there are some pockets of strength. For the first time, we added a new position in this group. We added some Iridium when the breadth model turned higher. Again, a stock that was way outperforming the group. Iridium is a satellite company, provides mobile voice and data communications via satellites. And again, look at the pop it's had just over the last 2 weeks as the market started to improve. And real estate continues to be weak. So some haves and have-nots. The one group that's starting to show some improvement, and we talked about this a few weeks ago, we had put on a couple of positions and then got stopped out, was consumer discretionary. It is a very broad-based group. What I can say is that this week on the sector models, restaurant sector started to show some improvement. The apparel group started to show some improvement. We saw some improvement in auto, as we mentioned when we went through the sector chart. And so there's a couple of things that we've added. We did add some O'Reilly Automotive. You know, they've got 6,000 automotive parts stores across almost all of the US. And it's safe to say that if car payments are going much higher and new cars are in short supply, do-it-yourself customers might be willing to buy parts to fix existing cars. And so this one is certainly outperforming the consumer sector. And the restaurant sector, a company called Texas Roadhouse, TXRH, we added again almost in all 50 states, has been moving sharply higher from a relative strength perspective since June, when the market made a new low in October. Look, stock's already up from 68 to 84, and a quick run from 84 to 95. This is clearly a leader within the group. So there are things to do. When we look at our holdings, we're still very cautious. We have our significant energy weight, an overweight position in financials, an equal weight position in industrials, which is largely defense companies, consumer staples for the dividends, healthcare for the consistency, although it's an underweight. But we have a very large cash and very short-term bond weight. about 35% all in. That's liquidity. Those are things that can be turned into cash immediately if we need to start adding new positions. When you throw in corporate bonds, it's closer to 40%. So we'll see what develops. As always, when breadth models turn higher, we start with some small partial positions. We will only add to those positions on strength. We will not average down. Putting more money into your underperforming securities just only incrementally increases your risk. We maintain a market weight in materials, not because we don't like them, but because they are very economically sensitive and we recognize there are risks. And we remain almost void of technology, real estate, and consumer discretionary, other than those two small positions that we've added. Outside of the US, Japan surprisingly continues to hang on. We have a small position, currency hedged back to US dollars. We've seen nice outperformance in Brazil, likely due to the fact that they started raising rates much earlier than the US. And they do have very strong exposure to basic materials. And to circle back to the beginning, the S&P continues to be in a long-term bull market. Now, this 200-week moving average will be an important line in the sand, and we'll continue to watch for risks. If the breadth models start to turn down again, or specific sectors we're focused in start to lose their strength, or specific positions don't work out even though the sector is, we'll carve back our weights. But there's reason to think that we could be into quite an important tactical rally at any point. Seasonally, we know this is the time of year where markets tend to bottom and we at least get some period of relief. The fourth quarter generally is the best quarter of the year. We've come into it where the average investor is really underweight equities. If you take global asset managers, there are fewer people overweight stocks than any time, even prior to 2008. We know that hedge funds and asset managers have very, very large short positions in futures, trying to hedge out what they perceive are the risks. We know the cash positions at asset managers are as high as they've been since 2001. 21 years ago. People have had lots of time to get defensive. Last Friday was the biggest day of retail or individual investors buying puts, which are used to protect them against a decline in history. So when something is really obvious and everybody is prepared for it, often it doesn't happen as expected. We just know that positions are very, very light. Investors are very, very cautious, and there's been a tremendous amount of bad news. If something isn't moving lower against that environment, there's probably a reason why it's outperforming. And we don't want to ignore those market signals. Margin debt is exceedingly low, meaning there's not a lot of people that have to sell if the market starts to weaken further. And when we got that difficult inflation print on the CPI 2 weeks ago, market opened down and then rallied on the day. There was no new news. So I understand that people are feeling really, really negative. Last week, we tried to explain why it was we don't have a 0% weight in equities. And I think we're in the right position at the right time. We know that when the market has terrible 9-month periods, the forward-looking results tend to be pretty good. So we don't want to get too far on one side of the boat. We want to stay balanced. We want to stay flexible. And the portfolios are in that position. Seasonally, from a presidential cycle perspective, we know that tends to be in the second half of October, equities generally start to rally. And if you take November through April, in every pre-election year, that period has been positive. Not to say it can't be negative this year, but there's a lot of data behind this. And then finally, credit markets continue to be benign. These are the spreads that corporate bond investors are demanding to take risk buying a corporate bond. This is when markets are stressed. This is showing a little bit of stress, nothing significant. So last thing, we're now into earnings season. And about 10% of companies have reported in the S&P. It really wasn't worth talking about the results so far, even though in general they've been pretty good. There has been no earnings apocalypse. In October, 68% of companies will report. That means the next 2 weeks are going to be fast and furious, and we'll talk about it again next week. But by the time we get through the first half of November, almost everybody will have reported, and we will have got color as to what we expect going forward, and the markets will have responded. If things get difficult, we will get more defensive, but we're very defensive as we sit. With that, if there are any questions, and I've talked a little bit too long, I'll see if I can take them. So let me take a look at the questions. A question from the West on the inverted yield curve. Okay, so let's just talk about that quickly. Yield curve is inverted. It's inverted all the way from 2 years out to 30 years. 3 months to 30 years, I don't believe is inverted at this point, but it will invert if we're going to have a recession. Look at the inverted yield curve says we are likely to have a recession. And the one thing that I would say is that it's important to know if we might have a recession and be prepared for it. But it depends on what kind of recession, right? If you think about it, if you went back over time and broke the world into secular bull markets and secular bear markets, there have been recessions in secular bull markets. They don't tend to be very deep. And the correction size tends to be 18 to 24%. If that's the case, we've seen that already. If it's a hard landing or some kind of financial crisis evolves out of it, and that's not to say that it can't, then maybe the market goes down another 15 or 20%. But the first thing that's going to happen is we're going to break that 200-week moving average. Around that time, we probably would see the breadth models turn back lower again, and we'd see some sector models turn negative as also. If you're going to go down another 20%, the leadership groups most certainly are going to break further, and that would cause us to reduce our positions more. So as we sit right now, we've got a very significant cash and short-term bond weight. My guess in the near term, we might wish to have less than that. But we'll watch for signs that things get worse. Credit default swaps will be important. Volatility levels will be important. Breadth models will be important. But if it just winds up being that we get a typical shallow recession, an inventory reset, then we probably have discounted that already. Last thing is, last week we talked about the fact when the rate cycle started in the late 1940s, rates rose slowly and steadily from 1948 through 1966, and there wasn't a single financial crisis along the way because the world was reflating. Rates were rising with the grain. In the period from 1981 to the present, every time there was like an against the grain rate cycle, it would raise rates until there was an accident, and then they would fall back. We'll see whether that's the case this time or not. Next question is wondering if somebody asking about our bond positions. Okay, to be really clear, our bond positions are exceedingly short-term government bonds as a place to hold cash, like 1 year in duration. So we're not making a bet on the bond market. We do think that at some point there will be a bond rally if the PMI data or the future orders continue to come down. There is a tight correlation between the bond market and PMIs. Bond yields will likely roll over, but we're not betting on when that might happen. We'd prefer to start seeing it happen before we would add a new bond exposure. So it's really just a short-term safe place for us to keep cash. There's one question on natural gas pricing. Natural gas pricing is falling, and it is for sure. It's come down to just a little over $6. Two things I take away from that. One is that natural gas producers in general are continuing to act quite constructively. So the equities themselves may be discounting a short-term pullback in natural gas prices. And we are in the shoulder season, right? We're in that period before it gets cold, at least here in Toronto for sure. We'll see what happens when the weather starts to get a little bit chillier. But what I'm watching for in natural gas is what the natural gas producers do. And in general, they've been consolidating and still remain quite constructive. We did reduce our natural gas exposure, but that's just on a couple of specific securities. And then the last question is from Carrie. If it's time to buy financials, do we prefer U.S. investments, regional banks, or Canadian banks? Well, we had a conversation about this today. We do own some Canadian banks. Personally, I believe in the short run, U.S. banks look better. Yields on the Canadian banks are very compelling, 5-6%. I really liked the reports that we got out of Bank of America and JP Morgan. We do own JP Morgan. But at the same time, we also really quite like the insurance companies. Progressive, for instance, is acting quite well, and they're very predictable business models. Also Unum, which is very tied to the pension market, and they're long-term obligations, and they're in very good shape. You can do this through ETFs, the KBE, which is the large banks ETF. It's acting well. Regional banks ETF, KRE or KIE, which is the insurance ETF. All of them, I think, are a good way to play this. But if we believe that the yield curve can steepen, if you believe that net interest margins can remain quite positive, and it looks like that way, if you believe that the consumer could remain in a better spot, certainly the U.S. consumer has less debt than Canadian consumers, which is one of the reasons I might look at the U.S. But the group as a whole, certainly is acting well relative to the S&P, and remember that banks have been through a lot since 2008. They've restructured their balance sheets. The risk level is way lower today than it was then. The leverage in their business models is way, way lower. And they, I believe, are probably in a pretty good spot to weather whatever economic downturn we may see. So combination of the dividends and potential capital growth, I think, looks pretty good. And with that, I think we answered all the questions. Okay, listen, thanks everybody for tuning in. Hopefully you find it useful. If you've got questions we didn't answer, give us a call or shoot us an email. If you'd like to talk about your portfolio, this is a service that we provide to make sure people are informed as to what we're thinking and what we're doing. But if you'd like to have a personal conversation, please pick up the phone, whether you're a client or not. We'll keep coming back every Tuesday, and please tune in and tell your friends. Have a good day.